For over 9 decades, if a massive infrastructure project went up in India, there was a good chance this company was pouring the concrete. Operating for years as ITD Cementation, they built a long reputation in heavy civil engineering. Then, in May of 2025, an Adani Group entity acquired control of the firm, and it was officially rebranded as Cemindia Projects. On paper, the company looks like a flawless growth engine, but they operate in the engineering, procurement, and construction sector. It's a highly cyclical industry known for razor-thin margins and cash flow bottlenecks. Let's look at the baseline. The stock is trading around 1,122 rupees, giving Cemindia a total market capitalization of roughly 19,200 crore. What really catches the attention of analysts is the momentum. Their yearly profit growth is sitting at a massive 62.4%. Usually, metrics like that signal an immediate buy. However, the EPC sector has a history of wiping out investor wealth when paper profits fail to materialize as actual cash. We must break down their financials, examine their massive order book, and identify the hidden red flags. To evaluate Cemindia properly, we must separate the enthusiasm surrounding the Adani acquisition from the harsh physical realities of building heavy infrastructure. Let's look at the company's core profitability engine to see exactly how efficiently management is deploying investor capital. This scorecard tracks return on capital employed, currently at an elite 32.8%. Return on equity is similarly strong, at 27.8%, efficiently generating profit. Factoring in the PEG ratio, measuring price against expected earnings growth, it sits at just 0.48. A PEG ratio below 1 typically indicates that a stock is heavily discounted relative to its massive growth rate. But there is a clear trade-off here. The stock's current price-to-earnings ratio is 32.8. Trading at nearly 33 times earnings means the market expects absolute precision. Management has to execute perfectly. If that 60+% growth rate slows down even slightly, a premium valuation like this can trigger a rapid and punishing sell-off. Cemindia has built an exceptionally efficient profit-generating machine, yet the current share price assumes flawless future performance, leaving essentially zero margin for operational errors. To see if they can maintain that flawless performance, we have to examine their backlog of uncompleted projects. Management is currently sitting on an order book of 24,545 crore rupees, spread across more than 80 different projects. Looking at the customer breakdown, 58% come from private clients, 36% from the government, and 6% from public sector undertakings. This mix is a major asset. It provides multi-year revenue visibility, insulating the company from short-term economic dips. The primary risk lies in relying so heavily on private sector capital expenditure. If macroeconomic shocks occur, like a spike in interest rates or liquidity constraints, private companies often freeze budgets. Those frozen budgets translate directly to stalled revenue. When we analyze the sector breakdown, two categories dominate. Maritime structures make up 33% of the backlog, and urban infrastructure accounts for 23%. Areas like data centers and hydro projects represent much smaller slices. Operating at scale in highly complex marine engineering creates a strong competitive moat, keeping smaller construction firms out of the bidding process entirely. This multi-billion-dollar backlog secures Cemindia's future on paper, but an order book only holds value if the clients actually pay their invoices on time. That brings us to the structural risks of the EPC sector, managing debt and maintaining working capital. Cemindia carries a surprisingly low debt-to-equity ratio of just 0.42. Pair that with an interest coverage ratio of 4.74, and the data shows they can easily manage their current debt obligations. In an industry that routinely drowns itself in debt to finance massive equipment purchases, this conservative balance sheet is a significant structural advantage. But there is still the working capital trap. Moving heavy materials requires constant upfront cash, and companies bleed capital rapidly if clients delay payments. Right now, Cemindia's debtor days sit at 47. That is how long it takes, on average, for clients to actually hand over cash for completed work. There is also the constant threat of commodity inflation. If the cost of steel, cement, or fuel rises unexpectedly, it can crush profit margins unless contracts have tight price escalation clauses. In heavy infrastructure, reported profits do not guarantee cash in the bank. Even a robust balance sheet remains vulnerable to a sudden liquidity crunch. So after weighing these specific trade-offs, who should actually buy Cemindia projects? The ideal investor profile is someone with high risk tolerance and a multi-year time horizon. If growth-oriented, this offers exposure to aggressive infrastructure expansion, accepting volatility for significant upside. Conversely, passive, income-focused investors should avoid this stock entirely. The macroeconomic risks, from government fiscal constraints to shifting interest rates, will simply generate too much anxiety for a conservative portfolio. If you do decide to invest, you need a strict monitor checklist. First, you must track whether their quarterly revenue actually matches management's forward guidance. Second, you have to watch their working capital discipline every single quarter. The projects presents a classic setup for growth at a reasonable price, but it demands active vigilance to ensure that a 24,000 crore promise doesn't degrade into a working capital nightmare. As always, this analysis is for educational purposes only and does not constitute financial advice. Please consult a professional before making investment decisions.